Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called Shark Ninja, ticker SN, trading just below $108. So what's been happening with this sector in this stock? So this is a company that some of you may know. They produce appliances that are typically high-end. So if you don't have any of the products, so they typically provide cordless vacuums, all the types of vacuum, floor care. They produce like blenders, air fryers. So it's a company that has been growing quite a bit over the last few years. And as you can see, has been doing so in a nice trajectory over 2023 and 2024. And I do think that that growth trajectory is going to continue. Let me explain why. First of all, my price target for this company is around 130, potentially before the end of the year. The company is profitable and they spend around 7% of their sales in R&D. So you can see here that revenues have been growing nicely. Last quarter, 30% plus growth on revenues year on year. And margins as well have increased overall to levels that are pretty attractive, just under 50%. So all that is definitely quite encouraging. At the same time, yes, the debt has increased a little bit over the last year, but to a level that is still very comfortable and serviceable, especially considering that interest rates are coming down now. So let's go back to the chart. In terms of where this company is trading at, you can see that it already has plenty of momentum going for it, right? And if we compare that to some of the competitors, so I've taken here Cricut, Helen of Troy, Whirlpool, Worthington, you can see that over the last 3 months and 6 months, the company has clearly outperformed its competitors. It is trading at a premium to the sector, so currently has one of the highest PE compared to the rest. The only one that's getting close to that is Cricut over here, where you can see that the performance is not as good. And I think the reason for that is because the revenue growth and earnings growth projected is certainly much, much better. So Shark Ninja is projecting revenue growth next year of almost 12%, whereas Cricut is projecting less than 2. So that's a big difference. Also, the net profit margin for Shark Ninja is by far the best in the sector. So it's getting close to 11, whereas typically the rest sit around 9 at best, and sometimes below that. So in terms of outperformance, we do see an outlier here, as well as on the quant side. Now, the volatility for the stock, if we have a look here, is not the highest. So we got around 40%, which is less so than other players. So all the players are trading at 50 or 60 plus, but I think that's really to be expected considering that this is, first of all, a high price stock that has been on the way up quite smoothly. So yes, we would perhaps want a little bit more volatility, but that does not exclude us from taking a position. So how have they been going about this growth trajectory? So the strategy of the company is to specialize in higher price segments and value-added products. So essentially, they try to sell products that solve customers' problems, and that they can charge a premium for it. So think about like really cool blenders and hair dryers that do things that all the competitors don't do yet. And they sell that through a multi-channel strategy to, enthusiasts of certain categories such as outdoor, beauty, young people, um, people who want to cook nice things at home. So they have 150 retailers globally. They sell on e-commerce like on platforms like Amazon too. And of course, they have their own direct to consumer strategy. We have here an example of uh, one of their latest innovations, and they're constantly launching new products. But one that was released recently, you can see the price here. It's priced at around 500 bucks in the United States. Is this Ninja coffee machine? So think about it. This is an area of the market that if you wanted to go premium years prior, you were probably looking at espresso, an espresso from Nestle and those type of brands. Now, the interesting thing is that they have reported that this particular product has been doing really well. And despite the high price point, right, because you can still go and get coffee capsules from maybe not so hot brands at a discount, this product has seen strong demand. So, as with any other industry, the strategy of these guys is to offer premium products and reduce the reliance on heavy discounting to drive sales. And that enables them to charge higher margins. In terms of their total addressable market, um, they see a total addressable market of 120 billion at the moment, but that continues to grow because they're entering new product categories and new geographic markets. So at the moment, they are very active in the United States, of course, but they have been quite successfully launching in the United Kingdom, and they're targeting now other new markets such as Germany and France. At present, the company estimates that the current penetration is less than 4% of their addressable market. So that leaves a lot of upside and growth in the medium to long term. So part of the challenges in the past was the geographical location of their supply chain. So they were historically focused on China, and over the past few years, as many companies out there have been doing, they have diversified their supply chain in countries like Vietnam, Thailand, Indonesia, Hong Kong, and now they're also exploring partnerships in Malaysia and Cambodia. So this has enabled them to reduce their cost base in terms of supply chain by 15%. With their suppliers, they have a long-standing relationship uh, for about 15 years, and their CEO, his name is called Mark Barocas, has been at the company for quite a while. So, quite stable there, been there for a long time, knows the company inside out, obviously. So, this is a decision that seems to have worked quite well for them. Um, Now they are in an expansion strategy, right? And when you look at the growth trajectory over the last couple of years, it's not a coincidence that this has happened due to not only increase in sales, but also the growth in margins. So the overall trend has been that there's been a general trend of point of sale outpacing shipments, indicating a period of, you know, retailer inventory reduction. But now, in 2024, US retail shipments grew about 30%, with their point of sale growing about 20%. So that is still positive news. Now, we have obviously the holiday periods coming. But the important thing is that these guys are feeling really good based on their commentaries on what they're doing, and they still see strong demand coming from the consumer to put their product out there. In the last quarter, in the earnings of Q2 this year, they noted that the destocking from retailers is mostly behind them, that inventories by retailers are still tight, but they're getting themselves ready in order to um, continue the sales expansion. So they mentioned rapidly growing areas like Germany and France, where the shipments outpace the point of sale, and they're building their inventory to support growth in those areas. So that looks quite positive. So they expect the point of sale and shipments to normalize and match each other more closely going forward. So assuming that retail sales stay up, and they should, then they should benefit in line with that. Um, in terms of risks, if we had the other scenario, US consumer weakening, yes, that could potentially that could potentially hinder the company. However, it's important to know that we're looking here at a premium brand with a stronger consumer profile. So that typically is a safer position than a lower income consumer, which, as we have seen, for example, in discount stores earlier this year, has definitely plummeted. So we can take the case of Dollar General, where we see very clearly that the company is on a downward spiral and has been for quite some time. And then the way that I see this playing is obviously significant upside left between now and the end of the year, and potentially running into the first half of 2025. Now, we have been through quite a strong move up for almost 2 years now. And whilst I think that may continue, I think the probabilities are that the stock may take a breather, may pause, may sideways for a while before the next earnings report. So one way to do this could be playing at diagonal spread. So I'll be buying slightly out of money calls, the 121 at 385, and sell the 125 for a credit of 138. So that still gives me exposure on the short leg after earnings for a few days. However, as long as the stock remains by 125 or below, I'm knocking in a profit of over 100%. If we are done with expiry, and then we are just left with 120 December leg open, then we can let that profit run, get to that 130 strike price target, and that provides us with a 300% return. Hope you enjoyed the video. See you soon.